Greetings and salutations, everybody. Today we're chatting with David Erfle. We talk about gold, the Fed, and ultimately the best way to deploy risk capital in this environment. But before we get into it, please hit the like button, subscribe, and ring that notification bell. And lastly, please let us know what you think in the comments, where you think the price of gold is going, or ultimately what you're doing to deploy your own risk capital. David, thanks so much for joining us today.
Always a pleasure. Thanks for having me.
Okay, so let's start off with talking about what's happening in China. We're seeing some talk that perhaps the West should be a little bit more independent in terms of sourcing their own parts of the supply chain. We've got the zero COVID policy, and we're hearing all sorts of different theories on what's happening there.
Yeah.
What's your general sort of outlook and analysis of what's happening in China and how it's ultimately impacting global supply chains?
Well, I mean, it's huge. I mean, you got 400 million people, the state, various states of lockdown. I don't know if you've seen the videos coming out of there, but they're crazy. But, I mean, as far as how it's affecting the gold price, I mean, they can't get out and buy gold. They're huge gold buyers. And as far as the supply chains, I mean, Shanghai is a huge port. I mean, it's 4 times the size of the port in Los Angeles, where I live, which is the largest port in the U.S. So it's affecting everything. And as far as the Fed, raising rates to try to stop inflation, I mean, I don't see how they're going to stop the inflation that's a result of these supply chain issues.
So do you think that the Fed was too late in responding to inflation, or do you think that this was just sort of out of their hands?
Well, we're expected to believe that an institution that told us for months that inflation is transitory, to all of a sudden flip and say, hey, wait a minute, it looks like it's not transitory. Let's start raising rates. By the time that their inflation statistics are showing that it's over 8%, but real inflation is a lot higher than that. I mean, even former Fed Chair Bernanke came out and said they made a mistake in not raising rates fast enough. So absolutely, as usual, the Fed's behind the curve, and now they're chasing. And the stock market was sniffing that out. I mean, you take a look at the Dow, the S&P, the NASDAQ, and even Bitcoin, they've all got these ominous head and shoulders chart topping patterns that have broken their necklines. And those patterns were being formed all the while that all these Fed heads were saying that inflation is transitory. So the stock market was sniffing that out.
Mm-hmm. Now we're primarily small cap investors here. You see it above me, SmallCapSteve. The frustrating thing for us has been that the only asset category that seems to be doing really well in this environment is oil and gas. But there still doesn't seem to be much appetite from investors for oil and gas names. I'm curious here. What are you doing to position yourself in some of the more speculative names out there, or are you just avoiding them entirely?
Well, when everything flipped just past mid-April, when we had, as far as the gold stocks are concerned, we had the GDX and the GDXJ, the gold ETFs. We had them going up 9 of the previous 11 weeks into that reversal, but it was happening on lower volume. So when we had 7 weeks of gains evaporate in 1 week, I started to build up cash. So I've got a huge cash position now. And, when you've got the Fed now saying that there's going to be pain, when you've got the Fed saying that we're not going to stop raising rates until we get on top of this inflation issue, they're basically saying that we're going to create recession. And even former Fed Chief Bernanke said they're going to create basically create recession and a stagflationary one. So I've been building up a lot of cash because, when these things happen, when the Federal Reserve does a hawkish pivot like that, the stock market that went up from the pandemic lows, it was basically all on cheap money stimulus. And when the Fed announces that they're going to be taking the punch bowl away, and not only that, but start quantitative tightening, unwinding their $9 trillion balance sheet. I mean, how ridiculous their balance sheet, ridiculously high it got in comparison is when in August of 2008, during the global financial crisis, their balance sheet was only 900 billion. And now it's 9 trillion. So, I mean, this huge move from the pandemic lows was all mostly on cheap money. So the Fed is famous for, making these policy errors. And once they reverse and start taking the punch bowl away, it gets ugly. And this time it's going to get really ugly, I think, unfortunately. So I've built up a very large cash position, and I'm not adding to any speculative bets right now, because when you have these deleveraging episodes in the marketplace, everything gets sold. So, cash is a good thing to have. And as far as gold and gold stocks are concerned, they've started to decouple once the horrendous retail results came out in the US last week. Gold and gold stocks have started to decouple from the stock market. But if there's another panic wave of selling, everything will get sold, and that includes gold and gold stocks. So if you're in this sector, if you're in stocks and you haven't built up very much cash yet, I would strongly suggest building up some cash on this bounce here, because all these necklines have been broken on these head and shoulder tops. So I think they're gonna come back and back test these necklines, and it's already happening in Bitcoin. The Bitcoin neckline is 30,000, and the neckline in the S&P 500, Dow, and Nasdaq, I think those are going to be back tested, possibly into the next Fed meeting, which is the middle of June. And if the Fed comes out and they're waxing just as hawkish as they've been, and they're going to say, yes, we're going to go ahead, we're hiking 50 basis points now, we're going to hike 50 basis points in July, and if inflation doesn't come down, we might even hike 75 basis points. That's when the next wave down may occur. So I'm positioning myself for that possibility. That's not a prediction, but that's just me being safe. I mean, in bear markets, basically everybody loses. It's the winners are the ones that lose the least. So a large cash position is a good thing to have.
So it sounds like you're not necessarily of the idea that the Fed can't raise. That seems to be one of the popular things that we read all over social media, is that the Fed, they don't want to create wealth destruction. They're really just sort of talking. They're trying to talk down inflation and scare everybody into it. It sounds like you think that we could see the Fed actually follow through with raising rates.
Yes, because they're going to have, because once they pivot, they have to have a plateau to pivot from. So I think they're going to at least raise to 2%, and that would be at the end of the July meeting. And also at the same time, at the end of the July meeting, the Q2 GDP number will be coming out, and I expect that to be negative. And if it is, we are technically officially in a recession, because we'll have back-to-back quarters of negative GDP.
And yeah, now you're talking about raising rates into a recession, which
exactly, which is a scary thought.
So
go ahead, Jay.
So I guess I kind of have two questions there. One, so are you expecting them to continue to raise at that, or are you expecting a pivot once that recession figure comes in? Are you expecting them to begin easing again, or how are you kind of predicting things there?
Well, that's a great question, and I don't think they can raise much more past 2%, especially in an election year. So I would not be surprised to see, this is just speculation on my part, of course, you know, I'm
Oh,
not an
absolutely.
economist. I would expect them to start backing off after the July meeting, or maybe in the Fed speak, start saying that, hey, we've raised enough. Look, inflation is coming down, because I would expect inflation to at least start peaking a bit, and all it has to do is start coming down a bit, and they can just say, hey, look, inflation's peaked. We can back off now, and we can save all of you, basically. So I wouldn't be surprised if something like that happened.
So then connecting that a bit to gold in itself, it sounds like you aren't based on what you said today, it sounds like if gold stays where it is, you'll be quite happy with it versus the potential for it to go down with the market as a whole.
Absolutely, yeah. I mean, gold needs to hold that 1780 to 1800 level. We bounced from 1785 here, so I wouldn't like to see that level broken. And I think the only way it does get broken is if we have a capitulation event like 2008, global financial crisis, just everything gets sold. So, yeah, I mean, I would not like to see that 1780, 1800 level get closed below.
What in your opinion is required for gold to go higher at this point?
Well, the dollar would need to go lower. I mean, we've seen a peak in the US dollar. The 100 level on the DXY is a very key level. The dollar and gold were rising together on as a safe haven on war fears until that $100 level was breached on the DXY. And as soon as it was breached, the dollar and gold started to decouple from the dollar and started to be sold off. So what's happening now is the dollar went parabolic, and it blew through a 20-year resistance line at 104. Right? It hadn't been that high for 20 years. And it's showing now like it might be a false breakout. Basically, the dollar went parabolic. It was extreme overbought. We're seeing some profit taking. You know, Christine Lagarde, head of the ECB, comes out and says, yeah, we're going to raise rates. So all it takes is just one little spark on the bull side of the euro, which makes up, you know, over 50% of that DXY, and the dollar being extreme overbought and starting to come down. Well, it's coming down, it looks like, to test the uptrend line from when the parabola started, and that's around the 100 level. So if we see the US dollar get below 100 and start going lower below 100, that would be a catalyst for the gold price to get back above 1900 and start going towards 2000 again. I mean, let's face it, $2,000 is the number. I mean, $2,000 has been extremely strong resistance for over a decade. So when that $2,000 resistance area becomes support, that's when the gold sector really starts to move.
So David, we're total degenerate gamblers here. We are the speculators of speculators, which makes me ask a question about explorers, which are usually the last ones to go.
Oh, yeah.
What price do you think that gold's going to have to go to for there to be any retail interest in junior explorers again?
Yeah, well, as junior exploration companies, they basically consume capital. They don't throw it off. Mm-hmm. So they consume a lot of capital. So in a risk-off environment, those things are sold first. So as far as developer explorers, the companies that are developing projects that they've already proved up, multi-millions of ounces, and they're de-risking those projects, those will move before the exploration companies. The pure play exploration companies, those are getting hit the hardest right now, and will continue to get hit hard until the gold price makes a $2,000 floor as opposed to a ceiling. You know, what's happened is The reason why the gold juniors have been going the opposite direction of the miners is because you've had gold stuck in this range, this $1,800 to $2,000 range for over a year, while the price of everything has gone up. So it's costing them much more money to get the gold out of the ground. You know, the capex on their projects are going higher. The drilling costs are going higher. Everything's going higher, but the gold price. So the miners will be a great buy once this deleveraging process ends in the stock market, because I think there's a good chance that we might have a washout moment. That's what I'm preparing for. That's why I have all this cash. As a speculator, I want to have a lot of cash right now. So I want to be in the position to basically to root for either outcome. Either the gold stocks already bottomed and I can add to my positions on a breakout, or there's going to be a washout moment conclusion to this correction, and I have a bunch of cash to scoop up bargains when these things are trading at cash or close to cash value what they have in the bank.
Well, David, we really appreciate you joining us. Where can our audience go to get more of your commentary?
Oh, sure. Always a pleasure. JuniorMinerJunkie.com is the website, and junkie spelled with a Y. And I also have a weekly column that comes out on Kitco every Friday.
Awesome. Well, David, thanks so much. We learned a lot from chatting with you, and hopefully you'll come back on in the future after things have bottomed. We can pick your brain on where to get some great speculations.
Sure thing. Thanks for having me on.
Awesome. Thanks, David.
Thanks, David.
All right, everybody, please let us know what you think in the comment. Where do you think the price of gold is heading? How are you planning to deploy risk capital of your own? Are you sitting cash? Are you starting to make investments now? Or have you just been holding this whole time? Let us know in the comments. Also, please like, subscribe, and ring that notification bell. All right. Thank you, everybody.